Well, welcome everybody to the webinar for today. Glad to have you. We're excited to introduce the next course. As I was thinking of the next course, I thought what would be helpful to everybody. And I'm always thinking like a strategy, but I thought, boy, we're at a unique time of the year in the market. And so I thought about it and I thought, well, trading the fourth quarter in the election profitably. And, you know, when you look at the fourth quarter, the last part of the year, September, October, November, December, you think about what is on the plate, right? You've got the market, right? And we're kind of due for a pause in the market. But even though the market looks tired, how many of you thought the market looked tired a week ago? How many of you thought the market looked tired 2 weeks ago? How many of you thought the market looked tired 3 weeks ago? How many of you thought the market looked tired 4 weeks ago, 5 weeks ago? The point is, yeah, I mean, I get it. So things we're going to be discussing, you've got what the market's doing, and that's enough. Big earnings period coming in October. COVID is still around. And then, you know, the election, pre and post election. How do we maybe position some speculative moves before, after the market? What trades should we be doing now? So what's going to happen is a week from this coming Tuesday, the day after Labor Day, Mark Fenton and myself will lead the charges, and we're going to go 1 month because we want to provide enough time to do this. And we'll be meeting Tuesdays and Thursdays at 1 Central, Mark and I, and that's we're going to cover. What are we doing now? What tweaks are we making in the trading now? What's our plan for the next month? What's our plan going into earnings, going into the election and post-election? And so, you know, this could be a very tumultuous, frightening thing to go through. So we're going to go through this together, and I think it'd be a good course with all that's on the table. And in terms of, and it's also from a trader, a lot of times we focused on a strategy. Here's one of the few times when we do a course that you're going to get it, instead of saying we're going to focus one strategy, it's more putting the whole thing together, right? Mark and I are going to look at the market. We're going to look and go through that process every class. Well, what should our plan be? What strategy should we put in? So, you know, the nice thing is you may get some multiple strategies that we may be talking about, but you're going to get a very narrow, specific plan. And I think from a 30,000 feet up in the airplane, this would be a great opportunity versus a very, you know, class specifically on credit spreads or specifically on butterflies. We'll be hitting on those as we trade them. So we want to invite you coming this Tuesday as we dive into the next, you know, the very potentially volatile 4 months coming. And again, this is the last week of August. A lot of people are holidaying, but I think come next week, you know, as they say, game on. Agree? So it's more, and again, and the wonderful thing coming into it, I have no idea where the market's going, and you don't either, right? But we're going to go, what are the strategies? What is the market telling us, right? That's how we trade at Sheridan Mentoring. What's the market giving us, right? And then we trade. Then we put some trades on, many non-directional, heavily focused on risk management, but it'll be, I think, a great help to you how to run this business as we go forward over the next 4 weeks. So that's what it is. And I'll talk a little bit today just on a few things as kind of an intro to this. And you can see, let me bring something up. Can you guys see my price chart of SPX? All right. And as you see here, here's basically a 1-year price chart. And you can see, over the last, if this is more kind of the last 2 months in the market, you could see here kind of like slowly upward trending until the last week. In the last week, we're starting to get a little bit of speed to the upside, and that's what dragged the VIX up, right? When you start getting speed to the upside, if you look at a chart maybe after this and look at the end of 2017 was one instance. Towards the end of the year, December, market started flying up, and VIX was 10 at the time, and then VIX kind of went up to 12, 12 and a half. And then after a month of going up, they tanked the market. I'm not saying they're going to tank it again, but I just think, getting speed to the upside is what caused the VIX to go up, right? And so definitely starting to tweak things a little bit already, and we'll talk more about it next week. But many different things to come up with. But I think the first thing we'll do Tuesday is kind of come up with kind of an overall plan. And again, we do things pretty simply. We don't put on a lot of trades, very simple, but something that makes sense what the market's giving us. Anyways, thanks, Kel. I didn't tell Kel to write that down, but that is very, Kel, you could send that to Dan at Sheridan Mentoring. We'll take care of it, but thank you. All right, let's look at something for today. Again, the range-bound income trades, calendars, and that type of stuff has been doing well. Let me just go over one trade that's been doing well. Put credit spreads. And I'll talk about that. How many have been doing put credit spreads or long diagonals, kind of taking a neutral, we call it at Sheridan Mentoring the long portfolio, more neutral to bullish over time. So if you're new to this type of thinking, picture in your retirement account, you buy stock, and maybe at work you buy, okay, every paycheck $100 or $200 goes into stock or a mutual fund. And you're taking a neutral bullish approach over time. So intentionally, every paycheck you're putting money into a neutral or bullish position. We do the same thing with options versus stock, because options have a lot better yield potential because they cost less. But here would be an example of something pretty simple, a put credit spread that's been working. And I'll just point out a couple things on it. And one of the things we'll be talking about next week also, because I think it's still appropriate, even though there's a little hazard signs you'd have to put with it. But here'd be an example of a put vertical credit spread, even though the market's been going up. So here I am 18 days out, September 18, and September 18 would be 2 weeks from this coming Friday. So September 18th would be 2 weeks from this coming Friday. I'm tempted to give you, I like what Leo's one of our veteran students. I was talking about put credit spreads today. I'll show you this one, then I'll show you, I'll bring up what Leo mentioned, that was a good idea, but I hate to mention that with a lot of you newer people. It's got a little more risk to it. I'll explain it at least after. But so here'd be an example. So 18 days out, and I might look to, you say, how would I choose my short strike? So this is called a put credit spread. And it's simply a probability trade. I'm selling, really, what I'm doing is selling a put out of the money, right? That's it. And then I'm buying a put against it as a hedge. But the whole purpose of this strategy is sell a put out of the money. So with us at 35.08, and again, I'm using a SEP 18 expiration in 18 days. I'm selling a put about 150 points out of the money. I'm selling the 33.60 puts. And let's say I buy the 33.50s. Now, let's talk about this. First of all, when you're looking at this, and I sell the 33.60 puts, it is a delta. So I'm picking my short strike by looking at the deltas. I'm looking for about a 20 delta. Now, a 20 delta on the SEP 18s, 18 days out, gives me the 33.60 puts. And it says probability they'll be out of the money is almost 80%. Probability out of money, 80%. Or here, almost 80%. So a 20 delta means there's only a 20% probability over the next 18 days that we're going to finish below the 33.60 strike. Can it happen? Sure. Is it high probabilities? No. And if you look at the expected move over the next 18 days, which is basically like a standard deviation, the expected move in think or swim here is 144 points. So they're saying there's a 68% probability that will be plus or minus 144 points. So over the next 18 days, if we're at 35.08 right now, they're saying there's a 68% probability, right, in the next 18 days that we're going to be on the upside. 35.08 plus 144 would be 36.52. And then on the downside, 35.08 minus 144 would be 33.64. Now, they're saying there's a 68% probability over 18 days we're going to be between here and here. Now, our short strike is 33.60. 33.60. So again, this is just showing that probability-wise we shouldn't be under that. Now, let me throw something else out. If I put on a trade 18 days out, am I obligated by law to stay in it 18 days? If I put on an 18-day put credit spread, do I have the right as an American citizen to get out of it in 7 days? Yes or no? Do I have to stay in it till 18 days? So here's the thing. I'd say 80% of the time, if I'm going to do an 18-day trade, I'm out of it in a week, all right? I'm out in a week. So, because think about it. The less time we're in the trade, the expected move is going to be less, right? But so generally maybe an 18-day trade, I'm looking to be in it maybe a week, right? At the most, 4 to 5 days. Now, so here's what this trade looks like. And right now it's going for about $1.15 $1.20. I'll just put it $1.20 just because I can do math better on $1.20 than $1.15. So this is where the underline is 3508. This is your short strike 3360. Oh, let me just put it at one contract. Here's your short put at 3360. This is your expiration graph in whatever 18 days. And this is how the graph looks now. So your graph on a put credit spread early in the position, kind of like an S a little bit, right? You can see how it, then it starts curving a little bit. Maybe this will go. Anyways, that's the graph. Now, a couple things to point out. If we do this for $1.20 credit, your margin would be $880. And for those of you with smaller accounts, you could do this 5 wide, but this would be $880. So if we look at potential yield, right, it'd be 120 divided by 880, about a 13.6% yield if you held it to expiration. So I'd probably look for about half of that, maybe closer to 7% is what I would be looking for. So if I was looking for 7%, 880 times 7%, and again, 880 is your risk. That's what your profit is based on, not your credit. So if I'm making an 880 and I bring in $1.20 credit, if I buy it back for 60-cent debit, right? So $60 divided by 880, it'd be about 6.8%, right? And then if I didn't want to lose more than, let's say, 10%, 10% of this would be close to $90. So if this were to go to 210 or higher, as they say in Cuba, get out, right? Now, that's a basic profit target and max loss, different ways to do that. And we would also talk about adjustments, what you can do. But that's a basic put credit spread. And you got a lot of room on these. These have been working well. I mean, you could do these in stocks also. But this type of trade, we would be doing it every, once a week till the cows come home, unless the market dictated otherwise. And we will go over, for the different trades we do, very specific indicators when we would not do butterflies or calendars or put credit spreads, very specific guidelines that you can watch as the market unfolds over the next month. But these have been a big deal. Now, what Leo was saying, and I think it makes sense, is that as you look at this week, how many people think much is going to happen this week? What everybody, unless there's something major happens news-wise, everybody's on holiday. Agree? Not much is going to happen. So Leo was looking for a continuation for the rest of the week that we may be up a bit, until everybody comes back from holiday. So he was looking at, Herb says not so fast, Batman. If you look at SEP 4, which is Friday, that gets a little dicier. But SEP 4, okay, now when you sell a 20 delta in a closer in expiration, it's going to bring you closer, right? A 20 delta for 18 days out gave me 3360, but a 20 delta that expires Friday ain't going to get that much room. You'd only get through like 34 45. So instead of being able to sell a put at 33.60, now I come all the way to the 34.45 instead of over 150 points out of the money because it's only 4 days from now. 34.45, so about 50 points. You give up 100 points. And so now here's the thing. Let me just see if I'm doing this. 33, wait, 34, I'm sorry, 34.45. Thank you, Mark. 34.35. So you don't get as much room, but here's the, as Clint Eastwood would say, here's the good, the bad, and the ugly. Is the 4-day getting as much or a little more than the 18-day credit spread? Yes or no? Is the 4-day getting as much credit or a little more than the 18-day? Yes or no? Is the 4-day trade getting as much or more credit than the 18-day? Answer is yes. So you say, shoot, Dan, if I can do a 4-day and get my money in a couple days instead of hanging around in an 18-day, I'm in. Yes, but what's the other side of that coin? The 4-day is only getting 50 some points, a little over 50 points out of the money. The 18-day was getting over 150 points. So the 18-day is a much warmer blanket in the winter time, isn't it? But so if we're neutral to bullish, the goal is you could get out of this in the next couple of days. If we have an update, you'd be looking at if you could buy, if we sell it for $1.25, or we could buy it 60 cents or lower. Yeah. Well, Gary says it moves against you, you're toast. Yes and no, you are. But if you have a plan, you've got to deal with it quicker, right? You've got to deal with it a lot quicker, right? You're going to run into trouble a lot quicker on the downside. So you just, one of the ways you deal with that is just by doing less size. As you get closer to expiration, you have more price risk and less volatility risk. So again, I think Leo's idea of doing this for this week, 4 days. Normally, Leo and the rest of us don't do 4-day spreads, but as far as how this is playing out, what's going on this week, the holiday coming, it makes sense, right? Once you get in the next week, everybody's back. All bets are off. Game is on, right? So I don't think that's a bad idea. And same principle. You can use the same risk management with the profit target and max loss. On the 4 days, you do the 16-day because they're about the same price. You're getting around $1.20 credit. Anyways, that's one of the things we're looking at. But I think if you join us, Mark and I, next Tuesday, and the folk at the veterans at Sheridan Mentoring, we'll kind of walk you through the next 4 weeks, make a game plan. We'll be putting on live trades every class and just showing you step by step how to navigate, right, through the, I say navigate through the Amazon rainforest, right? That'll be like the market the next 4 months. So anyways, if you have any questions on the class, you can email me, Dan at Sheridan Mentoring. Again, it'll be a 4-week class. Our 4-week will go for $397. We'll be meeting every Tuesday and Thursday for a minimum of an hour. So it'll be 8 classes. All the classes will be archived. They'll stay archived for months after the class, and you can ask questions So whether you watch it live or maybe you miss most of them because you're working and you watch it recorded, you can, there's a button there on the class page where all the slides are. You can ask questions anytime, and um, they'll come into me. So thank you, everybody. Look forward to trading the fourth quarter in the election profitably with Mark and Dan starting next Tuesday. You'll be able to go to Sheridan Mentoring and sign up. And that will be Tuesdays and Thursdays at 1 p.m. Central, 2 p.m. Eastern. Again, all the classes will be recorded and archived. And even if you watch it recorded, you could go to the class page, get the slides, ask questions, and it should be good. And we'll be doing exactly what we're saying, putting the trades on. So it should be a great class with what's going on. It should be interesting. A lot of fireworks going on. So, and we'll be doing some earnings stuff because you're going through the earnings cycle. Again, you've got, is the market going to take a pause? That's enough to deal with there, and dealing with volatility, the election, pre and post, COVID, earnings, a lot going on. How we're going to set things up before earnings, maybe some speculative plays. I'll call them little time bomb type strategies, different strategies. I'm looking at how you can position, even putting something on in January or whatever, if you think there's going to be a move. And so we're going to look at all different kinds of opportunities. So have a nice day, everybody, and we'll see you next Tuesday at 1 Central. Thanks so much.